Part 1. The Making of a Speculator. The world of finance is often described as a battlefield, a place where fortunes are won and lost in the blink of an eye, where decisions measured in milliseconds can change the course of entire lives, and where only a rare few manage to rise above the chaos, to see patterns where others see noise, to stay calm when others crumble, to keep discipline when greed and fear are devouring everyone else. Among those few stands one man whose reputation echoes across trading floors, hedge funds, documentaries, and whispered conversations among insiders. Paul Tudor Jones. A trader known not just for his financial success, but for his almost uncanny intuition, his relentless emotional discipline, and his defining moment in 1987, when he famously predicted and profited from the worst single-day stock market crash in modern history. But Paul Tudor Jones did not begin as a legend. He began like all of us, unproven, searching, hungry for meaning, driven by ambition he could not yet explain. To understand the man, we have to go back. A Southern heritage, Paul Tudor Jones II was born on September 28, 1954, in Memphis, Tennessee, a city of blues, riverboats, and a deep cultural rhythm that shaped his earliest identity. His father, Paul Tudor Jones Sr., was a respected newspaper publisher, editor, and a man of conviction. He wasn't just a businessman, he was a storyteller, a community figure, and someone who understood influence. Young Paul grew up surrounded by the printed word, columns, headlines, editorials, ideas that shaped how society thought. In that world, he learned two lessons early. First, the power of narrative. Second, the responsibility that comes with it. But while others saw the world in articles and letters, Paul saw motion, energy, competition, strategy. He was drawn to sports, particularly boxing. He would later describe boxing as one of the greatest emotional training grounds of his life. The ring teaches lessons the classroom cannot: discipline, timing, control under pressure, the ability to be hit and hit back without losing yourself. Those lessons would become his edge. The university years. Paul attended the University of Virginia, earning a degree in economics in 1976. But something important happened during those years. He became editor of the school newspaper. A coincidence? Maybe. Or perhaps a continuation of a family legacy. Yet while he honored his father's world, Paul's mind was elsewhere. He saw markets like a living organism, something breathing, changing, responding, evolving. Where others saw numbers, he saw emotion. Greed, fear, euphoria, despair. These, he realized, were the true forces behind price movements, not just balance sheets or interest rates. The soul of the market was human psychology, and understanding psychology meant understanding advantage. New York, baptism by fire. After graduating, Jones moved to New York. Not to follow a carefully mapped plan, not to join a powerful firm through connections, but to find out if he could survive. He secured a job with a small brokerage firm, E.F. Hutton, and soon began working as a clerk on the trading floor of the New York Cotton Exchange. To most people, cotton was just another commodity, but to Jones, it was a battlefield. The trading floor was loud, chaotic, aggressive, a ballet of sweat, speed, and instinct. Information came in waves and decisions had to be instant. He didn't just observe, he learned. He watched how traders moved their eyes, how they shifted their weight, how their voices changed when fear entered the bloodstream. The lesson was simple. Markets do not move because of data. Markets move because of human emotion. And Paul Tudor Jones had a gift for reading emotion, not just in others, but in himself. On the mentor, Eli Tullis. Paul's true breakthrough began when he met Eli Tullis, a seasoned cotton trader from New Orleans. Tullis wasn't just successful, He was respected. He traded not with computers, but with instinct sharpened by decades of battle in the pits. Tullis took Jones under his wing. Their relationship was intense, equal parts mentorship, challenge, and emotional sharpening. The Tullis taught Jones the deepest truths of speculation. The market is going to do whatever it wants. Your job is not to guess. Your job is to survive. Survival meant risk management. No matter how confident you were, no matter how strong your conviction, you never bet so much that a single mistake could destroy you. This philosophy would later define Jones's legacy. But mentorship is not without conflict. Paul was talented, and he knew it. His hunger for risk, for action, for decisive movement sometimes clashed with Tullis's older, steadier nature. Eventually, the two would part ways, not in anger, but because the student needed to step into the world and test himself. The first blow. Paul Tudor Jones began trading independently, and success came quickly, almost too quickly. In his early 20s, he made hundreds of thousands of dollars in cotton futures. Confidence soared. Momentum felt unstoppable. And then, the market turned. In a matter of days, maybe hours, he lost every dollar he had made. It was the kind of loss that breaks most traders. Not just financially, emotionally. Because once you rise above your old life and fall again, the ground feels harder than before. But Jones didn't quit. He studied what happened. He didn't blame the market. He didn't blame luck. He looked directly at himself, and he realized something critical. His failure wasn't lack of intelligence. It was lack of discipline. Emotion had outweighed logic. Excitement had overshadowed caution. Momentum had blinded risk. This moment, this collapse, would become a defining lesson. Losers average losers. Never add to a losing position. Never let hope replace strategy. Never let ego override survival. Jones would talk about this lesson for decades. It would shape his trading rules, his philosophy, and his legendary approach to market crashes. The formation of Tudor Investment Corporation. In 1980, with renewed discipline and unwavering conviction, Paul Tudor Jones founded his own hedge fund, Tudor Investment Corporation. He didn't begin with billions. He didn't have the luxury of institutional backing. He started with around $300,000 under management, including his own money. What he did have was clarity. He traded like a predator who understood the hunt. He cut losses quickly. He rode winners aggressively. He watched sentiment, liquidity, and volatility like a scientist watching the shift in weather patterns. But there was something deeper, something almost philosophical, shaping his approach. He believed markets moved in cycles, patterns, waves, repeating behaviors of human psychology. Not perfectly, but predictably enough for a disciplined mind to exploit. He began studying historical crashes, mania cycles, and financial panics. Tulip mania, the panic of 1907, the Great Depression, the bear market of 1973. A realization emerged. Every era believes it is unique, but human emotion never changes. To the rise of a reputation. As the early 1980s progressed, Jones began posting returns that caught attention. Not a lucky streak, but consistent, calculated, relentless performance. He wasn't just profitable. He was uncannily accurate in timing market turns, especially in commodities and equities. His colleagues noticed his ability to sit in silence, watching screens, breathing deeply, wait for the moment, and then strike with precision. He moved differently than other traders. Where others doubted, he committed. Where others panicked, he remained calm. Where others hesitated, he executed. His philosophy was simple, yet profound. Don't focus on making money. Focus on protecting what you have. Survive first, thrive second. This was not merely wisdom. This was strategy. Because survival gives you another day to act. And in markets, time is the greatest advantage of all. Foreshadowing the storm. By the mid-1980s, Paul Tudor Jones was no longer simply successful. He was becoming feared. He had one of the sharpest minds in macro trading. He had discipline forged in adversity. He had a hedge fund capable of rapid, decisive action. But something else was happening in the background. The US stock market had been rising rapidly throughout the 1980s, fueled by optimism, deregulation, and new financial structures. But beneath that rise, Jones began noticing fault lines, stock valuations climbing too quickly, volatility shrinking unnaturally, portfolio insurance strategies creating hidden systemic risk, a sense of euphoria spreading across Wall Street. To most, this looked like prosperity. To Jones, it looked like a bubble nearing its breaking point. He began studying historical crashes more intensely. He recreated market analogs from the 1920s and compared them to the 1980s, and what he found was disturbing. The patterns were aligning, almost perfectly. The world was heading towards something enormous, and Paul Tudor Jones saw it forming before almost anyone else. The date was approaching. The setup was nearly complete. The storm was building, and soon, the world would witness one of the most devastating moments in financial history. But one man would not only predict it, he would profit from it on a scale that would shock the entire financial world. The event was Black Monday, and that story we tell next. Part 2. Black Monday, the call that shook the world. The markets of the mid-1980s glowed with a kind of reckless optimism. America had entered a new era of confidence. Interest rates had fallen. Corporate profits were rising. Wall Street, once a domain of sober calculation, was now a theater of ambition. A new culture was taking shape, one built on leverage, speculation, and the exhilarating belief that the good times would never end. Investment bankers flooded into Manhattan. Young traders drove expensive cars they hadn't yet fully paid for. The music was loud, the deals were fast, the profit charts pointed endlessly upward. The American dream felt invincible. But markets have memories, they have rhythms, and they punish hubris with precision. Amid the noise, one man was listening closely, Paul Tudor Jones. The search for patterns. Jones was a student of history, not casually, but obsessively. He collected decades of price charts. He examined the rise and collapse of market cycles. He studied not only what happened, but why it happened. And he found something extraordinary. Market crashes were not random. They followed emotional cycles, waves of greed followed by fear, followed by panic. In his chart room, photographed later in a documentary, walls were covered with graphs, price curves, technical patterns, market cycles laid across one another like layers of geological sediment. Jones and his research partner, Peter Borish, went to work. They compared the 1980s bull market to the bull market of the late 1920s. The resemblance was not approximate, it was uncanny. The speed of the rise, the slope of the price curve, the compression of volatility, the public excitement, the belief that this time is different. Jones was not looking for catastrophe. He was looking for truth. And the truth was clear. A massive correction was coming. Not years away, but soon. Their portfolio insurance, the fuse. In 1987, a new financial strategy became popular among institutional investors. It was called portfolio insurance. In theory, it was designed to protect portfolios from losses. In practice, it worked like this. If the market began to fall, the strategy would automatically sell stock index futures to reduce exposure. The idea was to limit losses. But this strategy had a fatal flaw. If the market dropped sharply, everyone running portfolio insurance would begin selling at the same time. Selling would trigger more selling. Panic would feed panic. the system would reinforce its own collapse. It was a trap, and almost no one saw it, but Paul Tudor Jones did. He understood something simple and terrifying. The market was wired for a downward spiral, and once it began, there would be no way to stop it. Preparing for the storm. By late summer of 1987, Jones was certain. He began building short positions, trades that profit when markets fall. But his approach was not reckless. He did not bet everything on a single outcome. Risk control was his core discipline. He structured his trades like a military operation. Entry points were chosen carefully, maximum loss limits were predefined, positions were scaled gradually, liquidity levels were monitored constantly, stress tests were run repeatedly. He was preparing not just to be right, but to survive while being right. His internal conviction was strong, but externally, he was quiet, not bragging, not proclaiming, not warning others of doom. He simply waited, like a hunter who has tracked the pattern, the wind, the movement, and now watches the forest still itself before the strike. October 1987. The atmosphere was shifting. Small cracks began to appear in global markets. The US dollar was weakening, bond yields were rising, foreign investors were uneasy, and then, in the second week of October, the selling began. Not loudly, not dramatically, just enough to disturb the calm. Stocks slipped, then slipped again. The market seemed anxious, like an animal sensing danger it cannot yet see. Inside Tudor Investment Corporation, the team watched the charts with unwavering attention. Jones had trained for this. He was not excited. He was not afraid. He was focused. Every move was intentional. Every adjustment precise. The world outside had no idea what was coming. October 19th, 1987, Black Monday. When markets opened on Monday morning, the selling was immediate. It was aggressive. It was relentless. It was accelerating. The Dow Jones Industrial Average began to fall, not by points, but by hundreds of points. Traders froze. Phone lines jammed. Screens flickered with red figures no one had ever seen before. The fear was not ordinary fear. It was the fear that the system itself was breaking. Portfolio insurance programs triggered, and then triggered again. Machines sold because prices fell, causing prices to fall faster, causing machines to sell more. Feedback loop, death spiral, panic fractal. By the end of the day, the Dow Jones had fallen 22.6%. To put that in perspective, the crash of 1929, the event that triggered the Great Depression, took weeks to unfold. The crash of 1987 packed more destruction into a single day. It remains the largest one-day percentage drop in U.S. stock market history. The world was stunned. But inside Tudor Investment Corporation, something different was happening. They were not panicking. They were profiting. The trade of a lifetime. Paul Tudor Jones's fund ended the crash up more than 60% for the year. At a time when others were devastated, he had not only protected capital, he had grown it dramatically. It was not luck. It was not gambling. It was preparation meeting discipline. His conviction had been forged in humility, in the memory of losses early in his career. His confidence had been shaped by research, the deep study of market cycles. His execution had been structured by rules, risk limits, emotional control, and internal calm. In the aftermath of the crash, financial institutions were bewildered. How could one trader have seen it coming? The truth was simple. He looked where others refused to look. He questioned what others assumed. He studied history when others ignored it. And most importantly, he respected risk. This moment changed everything. Paul Tudor Jones was no longer just a successful trader. He was now a legend. The public learns the name. In 1988, a documentary aired that revealed Jones's strategy and mindset to the world. Its title was Trader. The film offered a rare glimpse inside his trading floor, his chart room, his psychological discipline, his refusal to tolerate complacency. It showed him pacing, analyzing, speaking in precise and thoughtful phrases. Don't be a hero. Don't have an ego. Always question what you're doing. It showed the human side of speculation, stress, gravitas, intensity, and yet control. The film became famous and then disappeared. Jones later requested it be removed from circulation. He didn't want to be mythologized. He didn't want young traders to imitate the stress or drama. He understood the danger of hero worship. Legends inspire imitation, but markets punish imitation. Paul Tudor Jones was unique, not because he was fearless, but because he respected fear. The philosophy that emerged from this era, Jones articulated the philosophy that remains central to his legacy. 1. Risk comes first. If you don't protect your capital, you won't survive long enough to succeed. 2. The market is emotional. Prices reflect psychology more than fundamentals. 3. Discipline is more valuable than intelligence. The greatest threat to a trader is themselves. 4. Patterns repeat. History is not identical, but it rhymes. 5. Always assume you can be wrong. Humility is not a weakness, it is armor. These ideas would shape not only his trading career, but his identity. He was no longer simply a trader. He was now a student of human behavior, a philosopher of uncertainty, a master of emotional resilience. The aftermath of triumph. By the late 1980s, Paul Tudor Jones was wealthy, respected, and influential. But he understood something rare. Success is not a finish line. Success is a test. For many, victory leads to overconfidence. Overconfidence leads to risk. Risk leads to downfall. But Jones remembered the pain of his early losses. He remembered the lessons of Eli Tullis. He remembered the fragility of fortune. He stayed cautious, patient, disciplined. He remained the fighter who had once taken punches in a boxing ring and learned not just how to strike, but how to stay standing. But his greatest transformation was yet to come, because legends are not defined only by what they achieve, but by what they become. And the next stage of Paul Tudor Jones's life would take him beyond trading floors, beyond profit, beyond markets altogether. It would lead him into a confrontation with meaning, purpose, and the future of humanity itself. A transformation from trader to philanthropist, from strategist to leader, from wealth to impact. And that story is our final chapter. Part 3. Legacy, discipline, and the price of greatness. Triumph is a strange thing. To some, it is the end of a journey, the place where effort is rewarded, where the destination is reached. But to others, to the rare few at the top, triumph is not a finish line, it is a threshold. After the events of Black Monday, Paul Tudor Jones became more than a trader. He became a symbol, a name spoken with respect, awe, even myth. But myth is dangerous, because myth can distort the truth. And Paul Tudor Jones never wanted to be seen as invincible. He knew the markets too well. He had seen too many brilliant traders fall. Fortune is not permanent. Momentum is not loyalty. Markets owe you nothing. Jones understood something fundamental. Survival is a lifelong discipline. Or the constant battle. Within every trader, no matter how experienced, fights the same enemy. Not inflation, not recession, not volatility, but themselves. Fear, ego, overconfidence, denial. These forces are silent, internal, and deadly. Jones had learned this early when he lost everything as a young trader and had to rebuild from discipline alone. He carried those lessons like armor, and he crafted rules for himself, rules that became the foundation of Tudor Investment Corporation. The rules of Paul Tudor Jones. 1. Cut losses fast. If a trade moves against you, exit. No hesitation, no emotion. Second, ride winners aggressively. When momentum is real, exploit it. Third, never overexpose. No single position should threaten survival. 4. Avoid ego. The market does not know you. It does not care about you. 5th, be humble, always. Confidence is useful. Certainty is dangerous. These rules were not just guidelines. They were survival mechanisms. Jones once said, "I am always thinking about losing money as opposed to making money. Don't focus on making money. Focus on protecting what you have." To many, this sounded counterintuitive. But to insiders, this was the voice of a master. Expanding the empire. Throughout the 1990s and early 2000s, Tudor Investment Corporation grew into one of the most respected hedge funds in the world. Jones began hiring top analysts, portfolio managers, and quantitative researchers. The firm diversified into global macro strategies, currencies, interest rates, commodities, and equities. But the core remained the same: discipline, risk control, human psychology. Traders at Tudor underwent intense training, not just in technical strategy, but in emotional awareness. Jones believed that trading was 95% mental, and the charts reflected what the mind refused to see. Every trader at Tudor learned, the market is a mirror. What you see in it is yourself. If you were impulsive, the market punished you. If you were patient, the market rewarded you. If you were arrogant, the market destroyed you. This was not metaphor. This was reality. The transformation from wealth to purpose. By the late 1980s, Paul Tudor Jones had achieved financial success beyond anything his younger self could have imagined. But success without purpose is a hollow prize. And Jones understood something deeper. If wealth does not contribute to others, it is incomplete. In 1988, he founded the Robin Hood Foundation, a philanthropic organization dedicated to fighting poverty in New York City. But this was no ordinary charity. Robin Hood operated like a hedge fund for humanity. It measured outcomes with precision. It tracked the effectiveness of every dollar spent. It cut funding to programs that didn't produce results. It scaled programs that worked. It combined mathematics with compassion. Today, Robin Hood has raised billions to support education, housing, healthcare, and community revitalization. Jones proved something profound. The same strategic discipline that wins in markets can also change lives. A philosophy of responsibility. In interviews, Jones spoke often about balance. He believed that success brings responsibility, not just to oneself, but to society. He understood that financial markets shape the world. They influence who thrives, who struggles, who progresses, who falls behind. And so he advocated for sustainable capitalism, moral investment practices, long-term thinking over short-term profit. He supported environmental restoration. He funded community development. He spoke openly about meaning, ethics, and the human spirit. For Jones, the question was no longer, how much can I make? But, what will I leave behind? The mind still sharpened by battle. Even as he grew older, Jones did not withdraw from markets. He monitored global macroeconomic patterns. He warned about systemic risks. He studied the rise of algorithmic trading, machine learning, and automated markets. He adapted. The world changed, but discipline remained timeless. He once said, "Markets change. Technology changes, but human nature never changes." Fear and greed were as present in 1987 as in 1929 as in ancient bazaars of trade. Patterns continue because emotion is eternal, and that, more than anything, was Jones's greatest insight. The price of greatness does not come without cost. The life of a macro trader is intense. Sleepless nights, uncertainty, responsibility for billions in capital, decisions that affect thousands of investors, employees, families. It is not glamorous, it is not easy, it is a weight, heavy, constant, unrelenting. Paul Tudor Jones carried that weight with discipline. But he understood something. To live fully, one must confront challenge. Avoiding risk is not living, but respecting risk is survival. And survival, sustained over decades, becomes mastery. Legacy today, Paul Tudor Jones is remembered not only as one of the greatest traders in history, but as a man who understood what is truly rare. Not the talent to rise, but the discipline to remain standing. He showed the world that intuition can be trained, that fear can be guided, that emotion can become strength instead of weakness. He taught that mastery is not about brilliance. It is about control. Closing reflection. In every era, there are storms. Sometimes they come quietly, like shifts in interest rates, inflation, currency pressure. Sometimes they arrive suddenly, like crashes, panics, collapses. The world always believes it is prepared. The world is rarely right, but somewhere, in a quiet room, a chart hangs on a wall, a pattern is repeating, a disciplined mind watches, breathing slowly, waiting for the moment. One eye on history, one eye on the future. And when the storm arrives, it will not be a surprise. Because markets do not reward intelligence, they do not reward confidence, they do not reward ambition, they reward discipline. And that discipline is the legacy of Paul Tudor Jones, the man who saw the storm before the world felt the rain.